Hey folks, Dan Frio here, the rate update. Special announcement. The Federal Reserve will be aggressively dialing back its mortgage bond buying. And they see 3 rate increases in 2022. So don't go away, that's what we're going to talk about next. Okay, so hot off the press, we have the CNBC News. They're going to break down exactly what the Federal Reserve said. Then when we come back, I'm going to show you market reactions and exactly what the Fed said in their notes. So don't go away. Watch this video. We'll be right back.
The Federal Reserve doubled the size of the taper to $30 billion a month. The Federal Reserve adjusted the tape, said that it will adjust the taper further if warranted. It did leave the funds rate unchanged at 0. It said it's prepared to adjust the stance of monetary policy if warranted by the economic outlook. It will maintain 0 rates until maximum employment is achieved. Now, the Fed is no longer using the word transitory, doesn't call inflation transitory. More on that in a second, but I want to show you what it looks for. The median Fed forecast now looks for a 0.9% funds rate in 2022. That's up quite a bit from where it was, and even more aggressive than we saw in our CNBC Fed survey, and for 1.6% for 2023. So call that what you want to call it, 3 or 4 hikes next year. 2 or 3 hikes next year, and another 3 the following year. Fed sees 5.3% inflation this year. That's a rise from its prior forecast, but it does see it coming down in 2022 to 2.6%. The Fed saying supply-demand imbalances are what are contributing to the elevated inflation level. It sees risks from the new variant to the economic outlook of the virus. The decision was unanimous. Job gains have been solid, it said. The unemployment rate has declined substantially. Now, importantly, and maybe somewhat amusingly, the Fed said it is no longer seeking inflation above 2%. So doubling the taper, but keeping it 0 and saying maintain it until maximum employment is achieved. Kelly?
Okay, so that's the news. Let's dial in what's going on here. So let me get my big head out of the way, and we will get working on this now. So the announcement that came out, the Federal Reserve will be aggressively dialing things back. Here's another statement that they said. So here is actually the verbiage that they actually put down. And that's why I said every time Federal Chairman Powell starts to speak, if he's looking up at everybody, he's kind of just going off of his knowledge. But when he wants to be really cautious, he'll start reading some things. So let me break down exactly the differences in the wording that they had from last month to this month. So here's a snippet of exactly what this is. And so we're going to drive down to this area right here. With progress on vaccinations and strong policy support, indicators of economic activity and employment have continued to strengthen. The sectors most adversely affected by the pandemic have improved in recent months. Previously, they said, but the summer's rise in continue to be affected by the COVID-19 cases. But now they say, but continue to be, this doesn't make any sense, but I'm reading it exactly the way they put it. Continue to be affected by COVID-19. Okay, job gains have been solid in the recent months, and the unemployment rates has declined substantially. You got to do all the cross-outs is exactly what they said last month, but didn't repeat this month. Many times when we analyze this, it is word for word identically to what they said the prior months. So then we keep going. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. Overall financial conditions remain accommodative, in part reflecting policy measures to support the economy and the flow of credit to the U.S. household and businesses. And then you go down through here. We're going to jump down a little bit through here, and there's a lot of cross-outs in this area. The committee seeks to achieve maximum employment. These are their 2 mandates I always speak about. Maximum employment and inflation at a rate of 2% over the long run. Well, earlier in the year, they came back and said, we really don't care what inflation does in the coming months. And as long as the overall is 2% over a time period, they never really gave that time period. So they completely backed off of that, and they just said, now we're going back to our 2% levels. Okay, at a rate of 2% over the long run. In support of these goals, the committee, scroll down, decided to keep the target rate of the federal funds rate. Again, what's the federal funds rate? It's the rate that interbanks charge each other, okay? Rate at 0 to 0.25%. With inflation having exceeded 2% for some time, the committee expects it will be appropriate to maintain this target range until labor markets conditions have reached levels consistent with the committee's assessment of maximum employment. Okay, then we scroll back down. In light of the inflation developments and the further improvements in the economy, in the labor markets. I'm sorry, guys. I know how to read, but it's with all these crossouts and everything I'm kind of going through. You get the gist of it. Okay, so bottom line, here's what they're going to do. The committee decided to reduce the monthly pace of net asset purchases by $20 billion. That's twice as much as they said previously for treasuries, and $10 billion, again twice there as well, billion for agencies. There's that word, mortgage-backed securities. I told you guys. Beginning January, the committee will increase its holdings of Treasury securities by at least $40 billion per month, and agency mortgage securities by at least $20 billion per month. Okay, so they're going to still buy, but not as much as they were. So again, when we're looking at all this stuff, when we're looking at this part of the puzzle, remember I was saying earlier, it's the supply demand of the bond, the mortgage-backed securities. They're not completely tapering everything. They're going to continue to buy in the tune of $20 billion a month. Okay, so it is half of what they're currently buying. So the demand just is in January is going to be limited by half. Hope you get it. Okay, again, the supply demand charts. So let me get my big head off the screen again. Okay, so that's basically what they're doing. Let's see the effects that we have on the market right now. Well, there was a knee-jerk reaction, but right now we see the MBSs, oh, you're seeing it live, is starting to tank, but it's all over the map. Honestly, if this wasn't baked in, this number would be in the 60s, 70 range. Let's see what the intraday chart is so we can see when they announced what happened. Go to the whole day, and there it is. Okay, you had everybody kind of hanging out, and then all of a sudden, poof. Okay, we had some support that brought it back in, but we're still down almost 30 basis points in the price of mortgage-backed securities. And again, let me make this clear. The Federal Reserve is pulling out how much in mortgage-backed assets they're buying, mortgage-backed securities. What that's going to do is limit the amount of buyers in mortgage-backed securities, thus reducing the demand, thus reducing the price. Therefore, what's going to happen? Rates are going up, and we're seeing that right now. Guys, this isn't a me fear-mongering, me to try to say, hey, you better do this now. I'm just passing along the information. There's no filters here. I just presented to you everything that was happened today and where mortgage rates are going. So if you're in the process of a mortgage right now, I hope you're locked in. If you're not, please reach out to us. We'd love to talk to you. If you're like, okay, Dan, I really need to do something now. I want to lock in, then refinance and so forth. Reach out to us. The best way to do that is reach out to therateupdate.com. I'm going to find that here for you in a second. Therateupdate.com. You're going to go right there, and there's multiple ways to get us. Give us a call. Let me get it over here. 844-775-5626. You can apply online or schedule a meeting with us. All you do is click right here, and it'll open up our calendar and let you guys know what times we have available that we can go over your scenario, your unique scenario, one-on-one. God bless, guys. Thank you so much for watching. I'll be back tomorrow at full force. So thanks for all your calls, thanks for all your emails, and thanks for all your loan estimates. We greatly appreciate all your support. Take care. Bye-bye.